In the third part of Chapter 20, we will be talking about sensitivity analysis and margin of safety. These are handy tools that managers can use to extract additional information from their cost, volume, profit analysis. Managers can use sensitivity analysis to understand how changes in their price or cost structure affect the firm's ability to break even or reach a target income. In other words, managers can use sensitivity analysis to test how changes in price or variable costs or fixed costs will affect the firm's ability to break even or to reach a target profit. For example, using our firm Acme Widgets from the previous section, we can take a look at the effect of a change in selling price on the firm's ability to break even. The old selling price was 60 cents per unit. Suppose the firm decides to raise its selling price by 6 cents. That would make the new price 66 cents. Now we have to figure out the new contribution margin. The formula for contribution margin is sales revenue per unit minus variable costs per unit. In this case, the new sales revenue is 66 cents per unit. The variable cost hasn't changed. Therefore, the new contribution margin is 30 cents per unit. Obviously, if the selling price increases and the variable costs don't change, the contribution margin will get bigger. Now we can plug the new contribution margin into our formula for break even. The firm has $1,500 of fixed costs. When we divide by 30 cents per unit contribution margin, that tells us that the firm now has to make 5,000 units in order to break even. When we compare that to the old break even, we see that as the contribution margin goes up, the firm needs to sell fewer units in order to break even. Does that mean that increasing the selling price by 6 cents is a good idea? It's hard to tell. Obviously, the firm needs to sell fewer units to break even, but that assumes that the firm's customers will be willing to pay 6 cents more to buy one of these units. If that's not true, then maybe it isn't a good idea. If that is true, then maybe it is a good idea. Here's another scenario. Supposing that the firm leaves its selling price where it is, but finds that one of its variable costs has increased by 3 cents per unit. How is that going to affect break even? The old variable cost was 36 cents per unit. The new variable cost is 39 cents per unit. How does that affect contribution margin? The formula for contribution margin per unit hasn't changed. It's still sales revenue per unit minus variable cost per unit. The sales revenue hasn't changed, but the variable cost has. So now the contribution margin per unit is 60 cents sales revenue minus 39 cents variable cost. That gives us 21 cents of contribution margin. In other words, because the sales revenue didn't change, but the variable cost per unit did, the contribution margin of each unit got smaller. In other words, each unit had to give more of its sales revenue to the firm to cover its own variable costs, and that left less contribution margin to go toward covering fixed costs or target profit. Now, we can plug that new contribution margin into our formula for break even, and we find that the firm has to sell more units now in order to break even, compared with the break even before the variable cost increase. In this third scenario, there's been no change in the selling price of the units, and there's been no change in the variable cost of the units, but the firm's fixed costs have increased by $150 from $1,500 to $1,650. How does that affect the firm's ability to break even? First, we have to compute the contribution margin per unit. Since there's been no change in the selling price or the variable cost per unit, there's been no change in the contribution margin per unit. Let's plug that information into our formula for break even. Here, our contribution margin per unit is still 24 cents, but we're going to need to sell more units in order to cover the higher fixed cost. When we compare the number of units that we'll need to sell to break even once the fixed costs have gone up, to the number of units that we had to sell to break even before the fixed costs went up, we can see we're going to need to sell more units in order to cover the higher fixed costs. Here are some questions to think about. If a firm increases the selling price for its product, what will happen to its break-even? Will it increase, decrease, stay the same, or maybe you can't tell from this information? That's right, the break-even will decrease because as the sales revenue per unit goes up, that's going to make the amount that the firm can contribute bigger. Therefore, the firm will need to sell fewer units to break even. What if the firm's variable cost per unit increases? What will happen to break even? That makes sense. The break-even will increase. As the variable cost per unit increases, it means that each unit contributes less toward covering the firm's fixed costs and any target profit. Therefore, the firm will need to sell more units just to break even. What if the firm's fixed costs increase? What happens to its contribution margin? Right. The contribution margin stays the same. There's no change in the selling price. There's no change in the variable cost per unit, so there's no change in contribution margin. But what happens to break even if the firm's fixed costs increase? Exactly. It's going to be harder for the firm to break even. Not because each unit is contributing less, but because it's going to take more units to cover the new, higher fixed cost. What if more than one thing changes in the firm's price or cost structure? For example, supposing a firm gets a new machine, and that machine has higher depreciation each month, but it's faster, so it uses fewer direct labor hours. That means that the firm's fixed costs are going to increase and its variable cost per unit is going to decrease. How will that affect break even? This is a tricky question, and the short answer is it depends. When the fixed cost increases, that means that the firm will have to sell more units in order to get enough contribution margins to cover the new higher fixed cost. But at the same time, the variable cost has decreased, so the contribution margin per unit is now bigger. That means each unit can contribute more toward covering the fixed cost, and that would make break even go down. In other words, this change might increase break even or decrease break even, or break even might stay the same. It depends on which effect is bigger. Margin of safety is another piece of information that may be useful to managers. It represents how far away the firm expects to be from the break-even point. In other words, how much could sales go down before the firm has to start worrying about not even breaking even, operating at a loss. There are 3 common measures for margin of safety. We can express margin of safety as how many units our sales could decrease before we hit break even, or how much our sales revenue could decrease before we hit break even, or we could express it as the percentage our sales could decrease before we hit break even. Let's look at each of these. For example, let's say that Acme Widgets expects to sell 7,000 units next month. To compute the margin of safety in units, we need to know the expected sales in units and the sales at break even. Luckily, we already know both of these. The difference between the amount that they expect to sell and the amount at break even tells us that our sales could decrease by 750 units before we have to start worrying about operating at a loss. There are several ways to compute the margin of safety in dollars. The easiest way is to take the margin of safety in units, which we already know, and multiply it by the selling price per unit. In this case, the firm's sales revenue could decrease by $450 before we have to start worrying about operating at a loss. The margin of safety ratio is the margin of safety divided by expected sales. When we divide our margin of safety in units by the total number of units that we expect to sell, it tells us that our sales could be 10.7% lower than expected before we have to worry about not even breaking even. This is the end of part 3 of this chapter.